Hi, so in this video, you are going to hear from Loan Officer Anthony go over pre-approval, what it means to get pre-approved, and what is required for you to get pre-approved. Anthony is one of the loan officers that I use for my clients. He's very educated, very informative, very helpful. So if you're ever thinking about getting pre-approved, please reach out to me or Anthony, and we will help you get started. Let's jump right into the video.
So pre-approval is going to be, if not the first step, the most important, because without the financing, unless you're paying cash for the property, you're going to have a tough time buying without the financing. So pre-approval gets you started on that path so that John can help find the right property that's going to fit your needs based on the pre-approval. It's not as easy as saying, hey, I think I can qualify for this. There's many aspects that go into this. So, a pre-approval is when a lender is actually evaluating and viewing all aspects of affordability. That's probably one of the biggest things that I'm looking at as far as pre-approval is making sure that the home that you're trying to buy and the loan I'm trying to lend is going to be affordable to you. Ultimately, most clients are looking at, hey, what's the max that I can buy? Many aspects there, but it's really about that monthly payment where affordability comes into play. So we are looking at the credit score, the income. We're looking at debt to income ratio, which is going to be how much debt you have compared to the income that you're showing. But I'm going to jump into the details of that. But the main benefits of having a pre-approval is you're able to see properties within your budget. It shows the seller and the agent that you're qualified to buy a home. Unfortunately, sellers do not want unqualified buyers looking at their homes. They want buyers coming in, prospective buyers that can actually buy the home. And that's why the pre-approval is so important. But it's also going to give you, as a client, better understanding of what your budget's going to be, what price range you should be looking in. Because if you're looking at once you start seeing homes, you're going to see many homes. Some you're going to hate, some you're going to love. But then some are going to be well out of your budget for the payment that you want. So we want to make sure that we're planning this so that you are looking at homes that are in the budget that you're pre-approved for to make this work efficiently. So documents that we're going to be looking for. So when you're ready to get pre-approved, these are items that I'm going to be looking for ahead of time so that we are already reviewing all this information so you are a pre-approved buyer. You've already been verified as far as income with pay stubs. We're looking at 2 years W-2s. Obviously, photo ID for identity purposes, 2 months bank statements to verify assets. If you are self-employed, the calculation is a little bit different. We have to average the income over the last 2 years. So in that instance, we're going to look at the last 2 years' tax returns. We are going to do a credit review. Now, the biggest question I get during pre-approval is, will this inquiry hurt my credit? Okay, that's probably the biggest question I get. The credit review is based on 120-day increments every quarter. So it depends more so on what you've done with your credit, how you paid your bills, how you use the credit cards, your balances versus limits. There's many factors there, but it's based on what you've done with your credit over the last 120 days. And then if you're shopping for a mortgage, it only counts against you one time as long as you do it within a 30-day time frame. If you have a lender look at your credit and give you a pre-approval this month and it goes past that 30 days, then it's going to be another inquiry after that 30 days. So if you're going to shop, you want to make sure you're doing that all within the 30-day time frame. So you're only getting hit once as far as an inquiry. Factors that could impact your pre-approval. Debt to income ratio. As I mentioned earlier, we're looking at your total monthly debts that would show up on credit. We're not looking at utilities or anything of that nature. We're only looking at what shows on the credit as a monthly payment, plus the new mortgage we're trying to lend against your gross monthly income. We're not looking at the net. We're looking at the gross. So that's before taxes, before any deductions. That's the income we're using to qualify. Employment status. You have to be a full-time employee, or you have to be if you're part-time, a client has to be part-time for at least 2 years to show that history of part-time employment. Credit score, minimum credit scores that we work with. We go down to a 620 with an exception, but typically it's going to be about a 640. Everybody's credit's going to be different. Whenever I'm looking at the pre-approval, I'm not just telling you, hey, sorry, I can't help you, have a nice day. I'm actually reviewing your credit, letting you know what's on there, and then setting up a game plan so that you can actually take those actions to get that score up so that we're able to actually qualify you within a specific amount of time, depending on how long it's going to take. And ultimately, payment history, that's always going to be important. Anytime you're borrowing money, every lender is going to want to make sure that you can make that payment on time and pay it back. So those are just key factors that could affect. Now, looking at a pre-approval versus a pre-qualification, I'm sure everybody's heard of a pre-qualification and a pre-approval, but the pre-qualification section is when a lender is just having a conversation with you, not actually verifying anything. And unfortunately, that pre-qualification isn't worth the paper that it's printed on, because they did not pre-approve you for a loan. They basically had a discussion with you and asked you a few questions, didn't really review credit or anything like that. And they're just coming up with an estimated amount based on what you told them and what you can possibly qualify for. A pre-approval is what we do. We want to make sure if you're out there looking at homes and you're putting an offer in, we want to make sure that you're closing based on the information that we already verified and the pre-approval letter that we've given you. So the pre-approval letter is what you want, and it's going to look sort of like the letter on the right-hand side. It has the details there. It lets the seller as well as the agent know you are qualified for up to this specific amount of money with a maximum payment of this. And if there's any other conditions, those are going to be listed there as well. But we're going to have pretty much everything already verified by the time you actually start looking at homes.